This is Matthew Cratter from Trade University, and today I want to talk about how super spicy inflation is giving the Federal Reserve heartburn. They're really in a difficult situation because if they try to raise rates a lot to tame inflation, they end up tanking the stock market. And if they don't do enough to raise rates, then they have inflation out of control. We saw the CPI inflation numbers coming yesterday. CPI inflation, which is really understates the true rate of inflation, I believe. But even this totally manipulated government figure came in at 7.5%. The inflation over the last 12 months was 7.5%. And this was a lot higher than the estimates were. And it was the highest CPI rating, this highest CPI inflation since 1982. So I thought I'd go back and take a look at what interest rates were doing in 1982 to give you an idea of how weird the situation is we're in now. It's much, much different from 1982. When you hear people say we need a Paul Volcker here, we don't really need a Paul Volcker because the situation is quite different. So in February of 1982, the CPI inflation rate was 7.6%, so slightly higher than the 7.5% inflation we just experienced. Of course, this was a much more real CPI number back then. So we're not totally comparing apples to oranges. But if you take a look at where the 1-year Treasury interest rate was, which this is the yield or the interest rate on a one-year T-bill, which is debt issued by the government. And one way of thinking about this, it's not exactly the same. The rates are not going to be exactly the same, but it's roughly like a one-year bank CD. A one-year bank CD theoretically should pay you a little bit more than this because of the increased risk. But back in February of 1982, when we had similar CPI inflation to what we have today, the CD rate or the one-year interest rate or the one-year risk-free rate was 14.27%. So the real rate, the way you calculate the real rate on something is you just subtract out inflation. So you're earning about 14% minus about 7.6%. The real rate at which your investment was appreciating was 6.67%. And this is basically, it's almost like you're trying to swim upstream and then the inflation is pushing you downstream. But back in 1982, you were still making a positive real rate of return. Your net worth, if you had everything in T-bills, your net worth was going up by 6 or 7% every year. Now let's take a look at what's happening today. Today, or yesterday, the one-year Treasury interest rate was 1.14%. CPI inflation is roughly the same as it was back in February of 1982. The real rate, we just take 1.14% minus 7.5%. We end up with another similar 6% number, but it's very important to notice the sign here. This is a negative number. So right now you're earning a negative real rate. And what this means is, let's say you have 100% of your assets, 100% of your savings in a one-year CD or one-year Treasury note, you are losing purchasing power by about 6.36% per year. So when we say that we have negative real rates, what it means is that your investment is not keeping up with inflation. And if you think about this over 10 years, the compounding doesn't work exactly like this, but you've lost something like 63% of your purchasing power if these real rates were to stay negative for the next decade. This is what's called financial repression, where there is central bank manipulation of interest rates in such a way so as to inflate the government out of its debt. But it is extremely repressive. This is the yoke that we suffer under because of central banks, where there's no place to safely park capital, at least in traditional assets. We'll talk about one place to park it at the end of this video, but there's no dividend yields don't keep up with 7.5% inflation. Bonds, even junk bonds, are trading below these interest rates. So that's what we mean by financial repression. Here is a chart of the one-year Treasury, and we can see how it even spiked up to 15, 16, 17% back in the early 80s. Right now, it is completely dead in the water. And we can see a series of lower highs and lower lows in this chart as interest rates peak out at a lower level each time. And this is what happens when you come to the end of a long-term debt cycle. So today is a very, very different situation. We can see that the one-year CDs are slightly under the one-year Treasury rate. They're at about 0.8%, 0.9%. Now, what does all of this inflation mean for the Fed's policy? Well, after yesterday's CPI number, the chances of a 50 a 50 basis point or half a percentage rate hike between now and the March meeting went up to 85%. So what this is saying is that there really is approximately an 85% chance that by this Fed meeting in March 16th, the Fed will have hiked twice, 2 quarter-point hikes or one big 50 basis point hike. There's an 85% chance of that. And what I would suggest is that, or I should say before in previous videos, we were talking about how this might just be a quarter percentage hike, but now that has moved up from 25 basis points to 50 basis points. And what I think this means is that there's actually a small chance as well that the Fed will raise rates as a surprise before the March meeting, what we'd call an intermeeting move. So maybe they raise interest rates in the next few days by 25 basis points and then raise it by another 25 basis points at the March meeting, or just do the whole 50 basis points at the March meeting. I should say basis points, they're 100 basis points in a percentage. So 1% is 100 basis points. It's just an easy way of talking about it. So as CPI inflation, as the headline numbers have moved up, the market is anticipating a much more aggressive Fed tightening. We can see that the 10-year note, which is really a benchmark rate, this is the 10-year Treasury, spiked quite sharply yesterday, hitting new multi-year highs. It's off a little bit today. Again, we're looking at yields here, so it spiked above 2% for the first time in a while. Now, as interest rates have been moving up, we've seen junk bonds and risk assets crash. This is HYG. These are high yield or junk bonds hitting new lows for the move. We've seen growth stocks get killed over the past couple months. This is the ARK ETF, which is a pretty good barometer for growth stocks. But really, this has been difficult for all risk assets, all bonds, and all stocks. When you see yields moving up like this, it means the price is moving down. So treasuries have been crashing along with high yield bonds, stocks, other risk assets, etc. So where are we in this cycle? I think one interesting way of looking at this is you can look at what's called the 2s-10s spread. And in order to understand that, we've got to take a look at the whole yield curve of treasuries. So this is government debt that's issued by the U.S. government, U.S. government bonds, also called treasuries because they're issued by the U.S. Treasury. We have the various dates on the left here. Yesterday was February 10th, 2022. And then we have the term or maturity of the bonds going all the way from 1-month T-bills out to the 30-year long bond. But what I'm going to be looking at here are what are called notes. I'm going to be looking at the 2-year note and the 10-year note. And yesterday, the 2-year note had a yield of 1.61%. The 10-year note had a yield of 2.03%, as we said, poking above the 2% level for the first time in a while. One very commonly used indicator to time Fed policy is looking at the 2s-10s spread. So what we do is we take the yield on the 10-year note and we subtract the yield on the 2-year notes. So we would take 2.03% minus 1.61%. We chart it, and we end up with something that looks like this. Now, when you get a yield curve inversion of 2s and 10s, this spread here will go negative, and this is what happened in the third quarter of 2019. And that's really a good sign that the Fed is done hiking. When the yield curve inverts, this is also a recession, can be a recessionary indicator as well. So we can see yesterday that we really plummeted this yield. This has just in the last few days has moved from about 90 basis points down to 30 or 40 basis points. When this gets down to zero, it will be a sign that the Fed is probably too tight and that they can't hike interest rates anymore. And bad things happen when the yield curve inverts, especially the 2s-10s. The yield curve inverted right before, call it 6 months before the pandemic hit in March of 2020. We probably would have had very bad financial markets, even if the pandemic hadn't gotten started at that point. But this was interesting. This is almost like the yield curve anticipated the pandemic. And I'll let you draw your own conclusions as to what that means. We can see here that the same point at which the yield curve went negative in the fourth quarter of 2019, this is approximately when Fed funds peaked as well. They peaked slightly before that, I'd say 1 quarter before that. But again, these are rough indicators. And then Fed funds fell off a cliff. This is the really short-term interest rate that banks charge each other, and it's set by the Fed. And this is, it's been basically at zero ever since the pandemic. And so when we're talking about the probability of a rate hike, this is the rate that we're talking about, Fed funds. And so the market, at least today, is expecting this to move up to 50 basis points by the March meeting. As I said, we're in a very different situation now than we were in 1982 when CPI inflation was at a similar number. If we go back to 1982, we can see that the debt to GDP level, basically debt is the money that a country owes. GDP is a measurement of the size of the economy and how well it's able to service that debt. And so you want debt, just as in your own household, you'd want your debt to your net worth or your productive capability to be as low as possible. The same for countries. Back in 1982, the debt to GDP level in the second quarter of 1982 was 32%. Right now, it's almost 100 basis points more than that. It's at 122%. And this is one reason we know that we're at the end of the long-term debt cycle. We're in a very different situation here where small changes in interest rates can have very large effects on the financial markets. And so what the Fed is doing, they're trying to inflate us out of the debt without crashing asset prices. And the Fed will continue to hike until things really, really break. And it looks like we're getting much closer to that with high yield breaking down and stocks breaking down as well as all the volatility we're seeing in the market. You can tell that this is a rough time, and it's a very, probably a terrible time for trading because you have very big down days and very big up days. So it's very difficult to be long this market. It's very difficult to be short this market. And this kind of high volatility is normally only seen in bear markets. I'm not going to rule on whether this is a bear market or not. I'll leave that up to you and whatever definition you use. But it does have the feeling of that. But it's a different kind of bear market. It's really a Fed-induced bear market. So as I said, we're in a very different situation here than we were in 1982. And this is one reason that we are experiencing financial repression and why real rates have gone negative. So back in February of 1982, as we saw, real rates were positive. Now they're negative, and the debt situation of the U.S. tells you everything you need to know about that. In addition, because of this, the whole U.S. dollar financial system is breaking down. We live in a very difficult time because of this, and it has a lot of downstream effects on social unrest, war between the classes, wars between countries, wealth inequality, etc. And if you want to learn more about how the US dollar system is breaking down, you can watch my video from a few days ago, which I'll link to below, the collapsing petrodollar standard, if you want to learn more about that. Finally, I'll end by saying that the one investment in this environment that just really stands out like a beacon is Bitcoin. Negative real rates are very good for Bitcoin, simply because if you're sitting in bonds, if you're sitting in fixed income, which is another word for bonds or interest rate products, these really are a sinking ship because of these negative interest rates. So if CPI inflation is at 7.5% and the stock market goes up, call it 10% a year on average, you still have an average. You still have a positive expected return. You just don't have this for bonds. So bonds are the sinking ship, and I believe that Bitcoin is the life raft. And we've already begun to see this, to see capital flows out of bonds and into Bitcoin. So one way to think about this is a traditional portfolio. You've heard of 60-40 portfolios where you have 60%, depending on your age, of course, and this isn't financial advice, you might have 60% of your net worth in bonds or your savings in bonds, and the other 40% in index funds or stocks. And what we can see in times of financial repression, it makes a lot of sense, I think, to tweak this. And so, for example, a very conservative financial advisor might tell you to move from 60% bonds to 55% bonds, keep that 40% stocks, and move 5% to Bitcoin or gold or something like this. And this is the natural progression. If you want to see an extreme version of it by a very smart guy, you can talk to Bill Miller, who a few days ago, or about a month ago, revealed that he now has 50% of his net worth in Bitcoin, the other 50% in Amazon. So a very aggressive investor, but also one who has a great track record and is a very, very intelligent guy. So this is one way thinking about financial repression, where the Fed stands and negative real rates, and realizing that on the margins, this is very good for Bitcoin. And you literally have more than $100 trillion worth of money sitting in treasuries, sitting in bonds. You probably have, maybe it's closer to 200 or 300 trillion. And this needs to make its way into Bitcoin, because the longer it sits in bonds, it's going to keep losing 5, 6, 7% every year. So on the margins, people will change their allocation. And what this means is very strong tailwinds for Bitcoin. And people like Bill Miller and presumably you and I are also trying to front run this move by owning Bitcoin. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.